picture a dusty warehouse. You know, nuts, bolts, maybe some safety goggles sitting on a wooden pallet.
Yeah, that classic kind of gritty industrial vibe.
Exactly. But now, I want you to picture a Silicon Valley tech darling, one that boasts a 31% return on capital with virtually zero headcount growth.
Which, I mean, that sounds like a total contradiction, right? Because historically speaking, industrial supply is, well, it's a business model that is notoriously vulnerable to every single fluctuation in the physical economy.
Right, like gas prices tick upward, your margins immediately take a beating.
Exactly. Labor markets get tight and your warehouses just grind to a halt. It's tangible, it's heavy, and honestly, it usually scales very clumsily.
But then you peer under the hood of Fastenal's Q2 2026 earnings presentation, and that whole dusty warehouse image just completely shatters. So welcome to today's deep dive into this fascinating source material.
It really is fascinating. We're looking at a corporate landscape that is honestly operating almost like a tech giant, but disguised in steel-toe boots.
And I know on the surface, a quarterly report about industrial fasteners might sound, a little dry.
Just a little bit.
But our mission today is to show you how this specific document is actually a blueprint. It's a hidden masterclass in scaling technology, driving operational efficiency, and completely outmaneuvering the inflationary pressures of 2026.
The headline numbers alone really demand attention here. I mean, for the second quarter, their daily sales rate, their DSR, grew a massive 14.7% year over year.
Which is wild.
It is. That brought them to $2.38 billion in net sales for just one quarter.
Okay, let's unpack this. So why should you care about a company moving pallets of safety gloves and steel bolts? Well, because their strategy right now is the ultimate playbook for doing more with less.
Yeah, they're showing the entire market how to completely decouple revenue growth from physical labor costs.
Which is the dream, right?
Mm-hmm.
But to really understand the mechanics behind that playbook, we have to look past the top-line revenue.
Right, you have to focus on the efficiency metrics. For me, the absolute anchor point in this entire report is their return on invested capital. Their ROIC hit 31.4%.
Wow, over 30%.
Yeah, up 180 basis points from last year. And crucially, it's sitting well above their historical 10-year average, which is around 27%.
So that jump to 31.4%, that tells us a very specific story, doesn't it?
It does. It says this isn't just a company brute forcing its way to higher revenue by, I don't know, blindly selling more products or jacking up prices across the board.
Right.
This is a fundamental structural shift in how they go to market.
And to understand how they are getting those massive returns, we have to look at who they are actually selling to.
Yeah, they aren't trying to just increase the number of small-time contractors walking up to a counter anymore.
No, they are out there hunting whales.
Yeah.
I mean, the customer site data in this report is just wild.
It really stands out.
They track these customer sites based on monthly spend.
Yeah.
Right. And the site spending $50,000 or more every single month grew by 16.5% year over year.
Just to put a scale on that, we are talking about 3,125 of these massive mega sites globally.
Over 3,000 megasites.
Yeah, and in Q2 alone, those specific 50K plus sites represented $1.38 billion in sales. So more than half of their total quarterly revenue is now concentrated in these giant corporate accounts.
But hold on, if they are hunting these massive whales, they have to be giving out steep bulk discounts. I mean, the report even notes their gross margin dropped by about 75 basis points down to 44.6%.
That's right. They're eating some unfavorable price and cost headwinds.
Right, like tariffs, transportation, and of course, this shifting customer mix we're talking about. So wait, if your gross margin is shrinking due to inflation and these big customer discounts, shouldn't your overall profit just suffer, like take a massive hit?
What's fascinating here is it didn't. And that brings us to the core financial mechanism Fastenal is actively exploiting. We can think of it as the margin seesaw.
Margin seesaw. Okay, I like that.
Yeah, because despite taking that 75 basis point hit on gross margin, their operating margin stayed perfectly flat year over year at 21.0%.
So they are sacrificing the top-line margin, but keeping the actual operating profit totally steady. It reminds me a lot of the Costco bulk model.
Oh, that's a really good comparison.
Right. Like you go into Costco, you buy a 50-pack of paper towels. Costco is making a razor-thin gross margin on each individual roll compared to, say, the corner bodega selling one at a time.
Exactly.
But Costco is thrilled because they just locked in a massive, absolute volume of sales from you.
And that volume is exactly what creates SG&A leverage. In Q2, their SG&A costs actually dropped as a percentage of sales, down to 23.5%.
Ah, so that's the underlying philosophy of this entire whale hunting strategy.
Precisely. They willingly surrender a little bit of gross margin at the negotiation table to secure massive recurring volume.
Because when you push that much volume through your existing corporate infrastructure, you just generate significantly higher absolute profit dollars.
Exactly. Think about it. If you manage an account that buys 1,000 fasteners a month, it requires a certain baseline of administrative work. Invoicing, account management, compliance.
Sure. Just your basic overhead.
But if you land a megasite that buys 1,000,000 fasteners, that administrative burden does not multiply by 1,000.
Right, that fixed cost stays relatively
Oh,
stable.
exactly. So the extra volume simply leverages your overhead. They are bridging the profit gap by making the business fundamentally more efficient per dollar earned.
Okay, so the math works beautifully in the boardroom, but I'm trying to picture this on a dusty factory floor. You can't just drop off 1,000,000 bolts at a $50,000 a month megasite and expect your overhead to magically shrink.
No, absolutely not. Someone still has to manage all that physical inventory.
Right. If you were servicing thousands of these giant industrial sites, how do you actually do it efficiently enough to physically lower your operating costs?
Well, you digitize the factory floor. You basically remove the human element from the routine procurement cycle entirely.
Here's where it gets really interesting. Because the growth numbers in their digital footprint segment are completely outstripping the rest of the physical company.
They really are. I mean, their overall company growth was that very healthy 14.7% we mentioned earlier.
But their digital footprint DSR grew by 16.2%. This digital segment now makes up 61.6% of their total sales.
Which is, staggering. Over 60% of this heavy industrial business is now flowing through digital automated channels.
So at this point, is Fastenal an industrial supply company, or are they an Internet of Things tech company that's just disguised as a hardware store?
That is the million-dollar question. To understand what that digital footprint actually looks like in the physical world, we have to talk about FMI.
Fastenal Managed Inventory.
Right. We are talking about smart vending machines, electronic bins, and automated weight-sensing inventory tracking. And this is stuff physically bolted onto the customer's production floor.
So cool.
In the second quarter of 2026 alone, they were signing 109 of these weighted devices every single day.
Over 100 new IoT devices deployed daily.
Yeah, bringing their total active installations to nearly 7,000 in just one quarter.
Wow.
And the sales generated purely through these FMI devices now represent 44.6% of their total company sales.
That is huge. And when you couple that with their e-business growth, the EDI integrations and automated web ordering, which increased by 12.6%, you really see a comprehensive digital takeover of the industrial supply chain.
You do. Just picture the workflow shift here. Let's say you are a shift manager at a massive automotive plant.
Okay, I'm picturing it.
10 years ago, if your team ran out of abrasive grinding wheels, it was a manual crisis. A floor worker realizes the bin is empty, writes it on a clipboard, and takes it to the purchasing department.
And then purchasing has to generate a PO, send it to Fastenal. Fastenal packs it, puts it on a truck, ships it out. I mean, you lose days of productivity.
Exactly. But now, in 2026, a worker just walks up to a smart vending machine 20 feet from their workstation. They scan their badge, grab the grinding wheel, and they just go straight back to work.
Meanwhile, that machine instantly registers the drop in inventory and automatically triggers a restock order through the cloud directly into Fastenal's system.
Totally bypassing the purchasing department. It functions seamlessly without a single piece of paper and, more importantly, without a single human decision required for replenishment.
So it's basically a massive competitive moat. I imagine once you let Fastenal bolt 50 smart bins and a dozen vending machines to your factory floor and wire them into your ERP software, switching to a competitor is just not going to happen.
Oh, it would be an operational nightmare. You'd have to untangle this massive digital knot just to save, a penny on a screw.
Right.
Connecting this to the bigger picture, these aren't just fancy vending machines. They are wielding tech sector dynamics in a legacy industry. That friction you described is exactly where the profit lives.
Because the switching costs become astronomically high, not from contractual lockups, but just pure operational dependency.
Exactly. It improves customer retention to the point where the relationship becomes incredibly sticky.
And circling back to the margin seesaw we discussed earlier, this automation is the exact physical mechanism driving that SG&A leverage.
Yes. Fastenal is capturing 15% more sales volume without having to hire an army of order takers or data entry clerks.
Or field sales reps, simply asking customers what they need to buy this week.
Exactly. The machines are doing the ordering, and they never ask for a raise.
Okay, let's pressure test this a bit, though. All this digital efficiency, the moats, the stickiness, it paints a flawless picture in a boardroom.
True.
But how is this theoretical tech utopia holding up against the rough, physical reality of the macroeconomic environment right now? I mean, if the broader economy is contracting, it doesn't matter how smart your vending machines are.
That's a fair point, but the macro wins in this Q2 report are actually serving as a massive tailwind. The broader industrial environment is showing very solid improvement.
Right. The US PMI averaged 53.3 for the second quarter.
And since anything over 50 indicates expansion in the manufacturing sector, we know factories are actively ramping up production.
And within that broad expansion, the absolute star of the show for Fastenal is heavy manufacturing.
Oh, without a doubt. Sales to heavy manufacturing end markets boomed, boasting an 18.1% daily sales rate growth.
Heavy manufacturing growing at 18% is just pulling the whole train forward.
It is the absolute engine of their current growth. And because heavy manufacturing is surging so aggressively, it's driving a very revealing shift in their product mix.
Okay, how so?
Well, their sales of direct materials, those OEM goods, the actual fasteners and components that go permanently into the products these factories are building, they slightly outpaced their indirect materials growth.
Oh, interesting. So the direct materials are the literal nuts and bolts of the finished product, whereas the indirect materials are the MRO supplies.
Right, the maintenance, repair, and operation stuff.
Like the safety glasses, the floor sweepers, the grinding wheels used to just keep the factory running.
Precisely. Now, indirect materials still make up the lion's share of their overall business, sitting at 60.8% of sales. That's their bread and butter. But the fact that direct materials are growing faster shows just how deeply embedded their FMI systems are becoming.
They aren't just stocking the janitorial closet anymore. They are integrated directly into the core production lines of these heavy manufacturers.
Exactly.
Okay, but this is where I really struggle with the physical logistics of those numbers.
Mm-hmm.
They're seeing nearly 15% overall sales growth, and heavy manufacturing demand is surging by 18%.
Right.
That means they're moving a massively higher volume of physical heavy metal objects across the country every single day. Even with the smart vending machines doing the automated ordering, the cloud can't drive a forklift.
No, it certainly cannot.
Someone still has to physically load the trucks. Someone still has to drive to these 3,000 megasites and physically restock the smart bins.
Yep.
So if demand is surging this aggressively, they must have had to hire an absolute army of logistics personnel to stock all these new vending machines and manage these sites, right?
This raises an important question, and it points to perhaps the most revealing, almost shocking metric in the entire earnings report.
I'm ready.
If you look at their employee statistics, their total personnel count for Q2 2026 sits at 24,795 people.
Okay.
That is only a 1.8% increase compared to Q2 of 2025.
Wait, let me make sure I'm hearing that correctly.
Go ahead.
They increased their daily sales revenue by almost 15%, moving millions of dollars more in physical goods, but they grew their headcount by less than 2%.
They barely touched their headcount.
That is insane.
The human footprint of the company remained almost entirely static while the revenue footprint expanded massively.
That is a total headcount paradox.
Oh, yeah.
How is that physically possible?
It is the ultimate proof that their digital strategy is successfully translating into the physical world. This is what scalable growth looks like when traditional industries adopt IoT infrastructure.
Because in a legacy distribution business, the relationship between sales and labor is super linear.
Extremely linear. If you want to grow your sales by 15%, you inevitably have to hire roughly 10 to 15% more warehouse workers, pickers, and drivers to handle the load. But Fastenal has broken that linear curve. The technology, the FMI devices, the predictive ordering algorithms, it's all absorbing the excess friction of that volume.
Think about route optimization, too. Because the machines are constantly reporting real-time inventory levels, a delivery driver isn't wasting time visiting a factory just to check if they need parts.
Exactly. They only deploy a truck when a specific cluster of bins hits a critical threshold.
The truck is loaded perfectly, the route is optimized by the cloud, and the driver drops off exactly what is needed.
Which allows their existing human workforce to be vastly more productive. One driver can service 3 times the volume they could 10 years ago.
That is wild. It really is a masterclass in doing more with less.
Which brings us to the final piece of the corporate puzzle.
The money.
Yes, the money. We've seen the aggressive sales growth, we see the digital tuck moat driving sticky relationships, and we see this incredible labor efficiency breaking the linear hiring curve.
Right.
But what does a business actually do with the mountain of cash that all of this operational success generates? Well, you look at their cash flow statement and their capital allocation strategy, and it paints a picture of extreme, almost clinical financial discipline.
Break it down for us.
Their operating cash flow for Q2 was $265.7 million. Now, that represents about 69.4% of their net income.
Okay.
That conversion rate is actually a bit lower than their historical average, but the report explicitly details that this is a side effect of their own success.
Really? How so?
The lower percentage is entirely due to higher receivables tied to that incredibly strong mid and late quarter sales growth. They sold so much so fast that they are simply waiting for the 30 or 60-day invoice cycles to clear.
Ah, so they can collect on all those new sales.
Yeah.
The ultimate good problem to have.
Absolutely. So with that cash in hand, they directed $60.5 million into capital expenditures.
This is them aggressively reinvesting in the machine that got them here.
Exactly. This CapEx goes toward IT infrastructure, upgrading their hub and spoke distribution facilities, and crucially, building thousands more of those FMI vending machines.
They are feeding the growth engine so the moat gets wider and deeper.
But the kicker is what they do with the rest.
What do they do?
After thoroughly funding that future growth, they returned $305.1 million directly to their shareholders in Q2 alone.
Over $300 million.
Yeah, that breaks down to $275.4 million in dividends and $29.7 million in targeted share repurchases.
So what does this all mean? Translate these hundreds of millions of dollars in cash flow into a practical takeaway for the listener looking at their own business right now.
It means that true financial discipline isn't just about the raw ability to generate cash. It's about the balanced strategic allocation of that cash.
Right.
They are heavily funding the technology and the physical infrastructure that guarantees their competitive survival in 2030, while simultaneously returning roughly 80% of their net profits directly back to the people who own the company today.
It acts as a highly stabilized, self-funding loop.
Exactly. The operational efficiency creates the cash buys more IoT technology, the technology drives even more operational efficiency and SG&A leverage.
And the shareholders reap the massive rewards of the entire cycle, spinning faster and faster.
It's an unstoppable flywheel.
So, to wrap up our journey through this report today, Fastenal is staring down an inflationary, volatile physical economy and completely defying the odds.
They really are.
They are purposely targeting massive mega accounts and willingly accepting slightly lower gross margins to win that sheer volume.
Right.
But they are bridging that profit gap by aggressively automating their supply chain with digital vending machines and deep e-business integrations.
And because of that massive digital moat, they are able to grow their revenue by nearly 15% while keeping their headcount growth practically flat at under 2%.
Which is incredible.
And that is the exact lens you should be applying to your own workflows or your own business strategy. You have to evaluate your landscape and ask yourself, where are your mega customers?
Yeah, where is that massive recurring volume that might easily justify a slight margin sacrifice?
And more importantly, where can you implement your own digital footprint? What routine, manual, clipboard-level tasks can you automate today to create your own fixed cost leverage?
So that when your volume doubles tomorrow, your labor costs don't have to budge.
Exactly.
It's about finding your own version of the smart vending machine. Which leaves us with one final lingering thought.
I like final thoughts.
We started this deep dive picturing that traditional dusty hardware store with manual bins of heavy screws.
We did.
But if a legacy physical nuts and bolts supply company can successfully digitize over 60% of its sales into a completely automated predictive ecosystem today, what happens in 10 years when every physical industry achieves this exact same leverage?
Wow.
Are we rapidly approaching a future where global supply chains become entirely invisible, self-monitoring and self-replenishing, functioning perfectly in the background without a single human intervention at all?
That is wild to think about.
It really is. It's definitely something to think about the next time you reach for a product on a shelf.